Imagine this. Trillions of dollars in real estate, bonds, and even fine art, all unlocked and traded instantly on the blockchain, democratizing wealth like never before. What if I told you this isn't science fiction? It's happening right now with real-world asset tokenization, and it's poised to explode in 2026. Welcome to the generational wealth community, your pathway from knowledge to legacy. Today, we're diving deep into real-world assets, or RWAs, the game-changing bridge between traditional finance and crypto that's capturing billions in value and reshaping how we invest. If you're new to this or a seasoned trader, stick around because we'll break down what RWAs are, why they're surging, the top projects leading the charge, and my predictions for where this heads next. All backed by the latest data as of early February 2026. First, let's clarify what RWA tokenization really means. At its core, it's the process of converting physical or traditional assets into digital tokens on a blockchain. Think of it like turning a piece of real estate into shares that anyone can buy, sell, or trade 24/7 without the red tape of banks or brokers. This isn't just about crypto hype. It's about solving real problems in finance, like illiquidity and high entry barriers. For example, instead of needing millions to invest in prime real estate, you could own a fraction for as little as a few dollars, earning yields or dividends seamlessly. The history here is fascinating. Tokenization started small in the late 2010s, with experiments in NFTs and basic asset digitization. But it gained serious traction around 2024 as institutions like BlackRock dipped their toes in. Fast forward to today, and the total value locked in RWAs has surged to about $24 billion, representing a massive leap from just $5.7 billion at the start of 2025. That's a growth of over 400% in a single year. Driven by tokenized U.S. Treasuries alone, accounting for around $9 billion, or nearly 40% of the market. And holders? They've jumped from 84,000 to over 800,000, showing real adoption beyond just speculators. Why the boom? Regulations are finally catching up. In the U.S., shifts post-2025 have encouraged more institutional inflows, with frameworks like the Genius Act paving the way for stablecoin and tokenization growth by 2027. Globally, Europe's MiCA rules are standardizing how these assets operate, reducing risks and building trust. Plus, blockchain tech has evolved. Zero-knowledge proofs ensure privacy, while Layer 2 solutions like those on Ethereum or Solana make transactions faster and cheaper. Now let's talk mechanics. How does tokenization actually work? Starts with an issuer, like a financial firm, verifying the underlying asset, say a bond or property deed. They then create a smart contract on a blockchain that represents ownership. Platforms use oracles like Chainlink to feed real-time data, ensuring the token's value mirrors the real asset. Investors buy in with stablecoins or crypto, and boom, you've got fractional ownership with instant liquidity. The beauty is composable with DeFi. Tokenized assets can be used as collateral for loans, staked for yields, or traded on DEXs, blending TradFi stability with crypto innovation. Speaking of top players, Ondo Finance is dominating with over $2.5 billion in TVL, up 404% year over year. They're tokenizing U.S. Treasuries and equities, offering products like USDY and OUSG that bridge chains like Solana and Ethereum. Then there's Centrifuge, focusing on private credit with scalable RWA pools for institutional lending. Polymesh stands out for compliance-built infrastructure, ideal for regulated securities. Realio network is pushing real estate tokenization, making property investment global and accessible. And don't overlook Chainlink, it's the backbone, providing secure data feeds for RWAs with top development activity alongside Hedera and Avalanche. BlackRock's BUIDL fund has already distributed over $100 million in dividends, though it got flipped by Circle's USYC in January for better DeFi integration. Recent buzz on X highlights even more momentum. Injective is integrating RWA stacks for institutional adoption, positioning as core infrastructure. Projects like XDC are upgrading to XDPOS 2.0, with over $717 million in tokenized assets. While Plume is partnering with Securitize for funds like Hamilton Lane, Maverick Network is building dedicated RWA infrastructure. and even Canton Network is seeing bullish trends amid market dips. Looking ahead, projections are staggering. Experts forecast the RWA market hitting $400 billion by the end of 2026, with some eyeing $2 trillion by 2030. Why? Tokenization could transform industries like real estate. Deloitte predicts $4 trillion tokenized by 2035, and fixed income, tapping into $130 trillion in outstanding assets. In 2026, expect expansion beyond treasuries, into private markets, consumer apps, and even agriculture via projects like Demetra. Stablecoins will play a huge role, potentially reaching $2.8 trillion, fueling RWA liquidity. But let's be real, it's not without risks. Volatility in crypto can spill over, regulatory hurdles remain. Tech like cross-chain bridges needs ironing out to avoid fragmentation. Always diversify and stay informed. In summary, RWA tokenization isn't just a trend. It's the future of finance, blending security with innovation for generational wealth building. If you're positioning for 2026, focus on utility-driven projects with strong partnerships. They'll lead the charge. Subscribe for daily recaps, drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only, and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.